Look at this. On September 2nd this year, I put money into my UK SIPP account. On 23rd September, the government added £250, calling it SIPP rebate. That's free money. Almost 25% return within 1 month. For 5 years, I was that typical NRI, sending every spare pound back to India, chasing 7% fixed deposit returns. I completely ignored this government tax relief, and that mistake cost me an estimated £50,000 in lost growth and tax relief. In this video, I will show you exactly how this works and how for me that 25% is actually a 60% return. Hello, I'm Dr. Suman. I moved from India to the UK back in 2015 to work here as a doctor with just £500 savings to my account. I had no idea how pensions, taxes or investing worked in this country. So I learned it the hard way by making expensive mistakes so you don't have to. This video is not financial advice and I'm not a financial advisor. So please do your own research before investing or consult a financial advisor. Today I will show you how SIPP gives 25 to 60% tax relief almost instantly. Why it beats Indian investment for NRIs earning over £50,000 a year, and my exact SIPP investment with zero platform fees. Warning, if you are planning to leave UK within the next 5 years, this video isn't for you. From 2015 to 2020, I sent £2,000 monthly to India, invested in mutual fund, fixed deposits and NRE accounts. That is almost £120,000 sent to India over 5-year period. Assuming 12% return, it becomes around £180,000 today. I am also assuming that this is being taxed in India as per the current tax rules. That includes the long-term capital gains tax. Now, what if I had put the same money within a SIPP account? This £120,000 will get tax relief of £48,000. The total becomes £168,000. Now, assuming 7% per year growth of this investment, this would become £250,000 by now. And within a SIPP account, there will not be any tax on this money at this time. So there is a £70,000 difference between these two portfolios, one in India and one within a SIPP account. This difference is without even considering the depreciation of the Indian rupees against the British pound. Now let's understand what is this SIPP or self-invested personal pension. This is a pension account that you can open and manage on your own. The single biggest benefit of SIPP is tax relief. It's the government literally giving you back the income tax you paid on your pension contribution. Here is an example. You earn £1,000, you pay £200 in tax, assuming you are a basic rate taxpayer. Then you take home £800. Now you put that £800 in a SIPP account, the government will pay another £200 tax that you paid straight back in that account. Your £800 investment instantly becomes £1,000. But for high earners in the 40% tax bracket, this gets even better. If you earn over £100,000, you fall into a 60% effective tax trap. By putting £10,000 from this bracket into a SIPP, you not only get that basic rate tax relief of 20%, but you also reclaim your personal allowance that was lost, making the government's contribution massive. It's the biggest financial cheat code for high earners in the UK. Let me explain that with an example. For an NHS consultant earning £110,000 NHS salary, last £10,000 is taxed at 60% roughly. So you keep only £4,000 of this. Now put £10,000 in a SIPP account. The basic rate tax relief will be £2,500. The higher rate tax relief will be another £2,500. And the personal allowance saved will be £1,667. That's a total £6,667 free from the government. Now, why will you reject this free £6,000 from the government? Within a SIPP, you control everything. The key features of a SIPP account are: choose from hundreds of ETF and fund, also stocks, including India-focused investments. You can change the investment at any time. The money grows tax efficiently within this account for now, but at the time of maturity, there will be tax implications for this money. The government keeps adding the 20% tax relief on your contributions every year, and as per the current tax rules, you can access this money from the age of 55 years, rising to 57 years in 2028. Of course, tax rules can change in between, so please do your own research regarding the latest tax rules and the rules concerning the SIPP account. Okay, so the next question is, who can open a SIPP account? You need to be UK tax resident, that is, you will be staying in this country for more than 183 plus days. You should have a national insurance number. You are under 75 years of age, and you can actually open this even with a visa. So as long as you have a resident permit, you are able to open this. I have my own SIPP with Invest Engine along with my ISA account. My simple 2 ETF strategy for my SIPP is, the first investment that I have within my SIPP is the FWRG, which is the Invesco FTSE All World. That includes almost 4,000 companies, including the Nvidia, Apple, Microsoft, Reliance. And the second ETF that I have is a technology focused ETF, IITU. It is around 40% of my portfolio. This is mainly focused on the technology companies based in US. The total fees that I pay on this portfolio is 0.15%. Compare this to the fee of 1% to even 2% in many Indian actively managed mutual funds. If you wish, you can also buy Indian investment within a SIPP. Examples are Franklin FTSE India or FRIN ETF. Also, you can buy emerging markets ETF, where around 15 to 20% will be invested in India. Remember, these are not financial advice or recommendation, so please do your own research when you are constructing your own portfolio. While investing, your capital is at risk and you can also lose your money. The charges for Invest Engine are platform cost 0, the cost of buying and selling investment is 0, and the charges to maintain the account is also 0. The only fee that I'm paying is for the expense ratio of the ETFs that I'm holding, which is around 0.15% at the moment. So how does this UK cheat code stack up against the traditional NRI route of sending money back home to India? The results are not even close. For years, my strategy was simple: earn in pounds and invest in rupees. This is the choice every NRI faces. Let's compare them head to head. Path 1 is sending £10,000 to India. First, you lose around 1% in forex fees. Then you invest hoping for another 12 to 14% returns, which are fully taxed by long-term capital gains tax, and you are exposed to currency risk. Your Indian portfolio has to work 30% harder just to stand still against the strengthening pound over a 5 to 10 year period. Path 2 is investing £10,000 in a SIPP, 0 forex fees. Your £10,000 gets an immediate boost of £12,500, or for me, over £16,000. All this growth is tax-free for now, but remember, it has tax implication when taking the money out at the age of 55 or 57 years. At the moment, you can take out 25% without paying any tax. If you want to invest in India, you can still invest in India-focused fund or ETF within your SIPP account alongside the US tech giants like Nvidia and Alphabet. But before you rush off to open an account, stop. A SIPP is a pension, and pensions have rules. Ignoring them could mean locking your money away when you need it most. If you are not sure, please consult a financial advisor. Also remember, investing carries risk and you may lose your money. Tax rules might change in the future, so never invest your money by watching a random YouTube video like this without doing your own research. Now let me explain the catch of a pension account. So here are 3 critical rules you must understand. The age lock. you cannot touch this money until you are 55 years of age, which is going to rise to 57 years in 2028. This money is for your retirement, not for a house deposit next year. Number 2 is 5-year warning. If you plan to leave the UK permanently within the next couple of years, the benefits are less compelling. This is a mid to long-term UK investment strategy. Number 3, remember the contribution limits within a pension account. You can contribute only up to 60,000 a year within all of your pensions. This includes your NHS pension, your other workplace pension, as well as the SIPP. The allowance is £60,000 a year or 100% of your UK earnings for that year, not more than that. Understanding these rules is non-negotiable. This isn't a get-rich-quick scheme. This is a get-rich smart but slow scheme. So now you know the rules. But what about the biggest question every NRI asks? What happens to my SIPP if I move back to India? I will answer this right now. This is the number one question that most NRIs ask, and the answer is surprisingly flexible. You have 3 great options. Number 1 is keep it in UK. Leave your SIPP invested in the UK and start drawing from it tax efficiently after the age of 55 or 57 years. Number 2 is transfer the money. You can potentially transfer it to a recognized Indian pension scheme or QROPS scheme, although this is very complex and I would personally avoid this. Number 3 is use it for your children's education. It can be a fantastic savings to fund your children's UK education maybe in next 10 to 15 years time. The point is your money isn't trapped. You have strategic choices. So you are convinced and you know it's flexible for NRIs. But how do you actually open and invest in a SIPP account? Here is your action plan. Step 1, choose a platform. I use Invest Engine for my SIPP account. Why? For a do-it-yourself portfolio like I do, they charge 0 platform fee. This saves me hundreds of pounds a year compared to other legacy platforms. Step 2 is build a simple portfolio. Don't overcomplicate it. My SIPP has just 2 ETF, 1 global fund and 1 technology fund. This also helps me keep the cost down. Step 3 is take action. Open the SIPP online. It takes 15 minutes. Set up a monthly direct debit. The key is to start. Setting this up is the first step. But what about the next 10 questions you will have? Getting quick, reliable answer from people who have already done it is the key to staying on track. This video gives you the what and the how, but the journey of building wealth in a new country is filled with specific what if questions. Questions about visa, remittance rules, and advanced tax strategies that you can't just Google. This is exactly why I created the NRI investment community. It's an exclusive community for Indian professionals living in the UK and it's completely free. We share detailed investment strategies but not financial advice, and you get direct access to a network of over 150 members on the same path as you. Stop trying to figure this out all alone. If you are serious about building wealth in the UK, this is your next logical step. Don't let another month go by where you leave free government money on the table. Join the community and let's build our wealth together. Link to the community in the description box below. This is Dr. Suman helping you build your wealth one step at a time. See you in the next video.